A lot of startups think that they can run out of cash because revenue didn't grow fast enough, but most of the time that isn't the case. So if you are a finance leader in a startup and you want to make sure that the company you work for doesn't run out of cash, then this is a video for you. This is part of my Startup Finance Mistakes series, and in this video, I'm going to walk through probably one of the most common reasons why people run out of cash or companies run out of cash to other reasons that are also quite common. And if you stay to the end, then you'll really understand the warning signs that many startups may ignore and then lead to real problems with cash. If you haven't watched me before, I post videos every single Thursday. I am a CFO of a scale up and I have been working with startups and scale ups for 20 years now. So one of the biggest misconceptions in startups is if revenue is growing, we're fine. But I can tell you from lots of experience that that is definitely not necessarily true. I have seen companies that have grown really fast and looking dangerously close to running out of cash, and that's because growth and cash are not the same thing. And in 2026, this definitely really matters because raising money is taking a lot longer than it did, say, in 2021. Investors are super cautious, costs are incredibly high, and there are lots of macroeconomic issues that we're having to deal with that just makes the market really volatile. And so founders are under a lot more pressure to show a path to profitability, and obviously you being the finance leader are too. So why do startups actually run out of cash? So usually it's not one big dramatic mistake. It's usually a combination of smaller decisions. So let's go through what that looks like. So the first one is focusing on revenue and ignoring cash timing. So another way of saying this is your working capital or cash drag, right? This is probably the most common issue. So let's say, for example, your company looks really healthy on paper, your revenues are growing, you may even be showing some profitability, but cash is getting really, really tight, and your cash balance is significantly lower than what it is on the budget, even though your P&L might be similar. So, this may mean that you have a working capital or cash drag problem. And what that means is that your cash is having to go out really fast. So, you're paying for annual software contracts up front, you're hiring headcount where you have to pay them, pay payroll quite quickly. Say your increased marketing spend with PPC and you're having to pay for that up front. Your cost of sales might be inventory. Again, you have to pay that up front, but your customers are paying really slowly. You may have enterprise customers where you haven't negotiated really good deals and they're paying 90 days on invoice. Now, if you're growing quickly, you can see how this cash drag becomes a massive problem. So while you can make sure that your working capital and your turnover of cash is the right way around. So you're getting payments as quickly as possible and you're paying as late as possible. And that is a lot of negotiation, a lot of time. It's also looking at your business model. So if your business model is constructed in a certain way whereby your revenue is coming really slowly and your costs aren't, then you really do need to revisit how that is working. So your P&L might look reasonable, but your bank balance tells a different story. And again, you really need to have a look at the timing of the cash movements. Number two is hire too quickly. So this happens all the time after a fundraise. I think I've seen that with nearly every fundraise. A business raises lots of money and immediately they hire really aggressively. They might even upgrade their office space, they increase software or AI spend, and really add a layer of management. And the assumption is growth will catch up. Sometimes it does, and sometimes it doesn't. And so once you have increased your fixed costs, which is your office expenses and your headcount, then it's very difficult to quickly reverse that if growth doesn't kick in as you expect. So really make sure that you are being very careful with your resource allocation and don't just go on a spending spree in the first 12 months of a fundraise. I know it's very difficult to do that. I know the founders find it very difficult to do that, but you must be very intentional with how you're spending this extra funding. Number three is that sometimes founders underestimate how long fundraising takes. So this is probably less of a problem now, maybe because people have been burnt. But fundraising timelines really are unpredictable, especially outside hot sectors. So if you're not in a hot sector, which today right now is AI, but that may not be the case in 12 months' time. So we used to be able to fundraise in 3 to 6 months. It's now looking more like 6 to 9 months, even up to 12 months. So this is why you really must runway plan properly as a finance leader, and it's best to start the fundraising much earlier than what we used to have to do a few years ago. So make sure you're doing that and planning for the fundraising long before you actually need the money. Forecasts are too optimistic. So, again, this is something I see all the time. Startup forecasts are often built around best case sales assumptions, really ideal hiring timelines, and a smooth execution. But because you're an earlier stage business, you're still finding your way. Reality is much messier. Deals slip, hiring takes longer, customers churn, costs increase. So a really good CFO then spends a lot of time pressure testing the budgeted spend and doing lots of scenario testing. And that's not because we're pessimistic, it's because startups very rarely go to plan, and you just need to understand what your levers are and what you need to pull at certain different situations so you're ready for all different scenarios, essentially. Another mistake is not understanding the real burn rate. So some startups only look at, say, monthly losses or headline EBITDA, but obviously that's not enough. You really do need to look at the true cash burn. So that is committed future spend, that is hiring obligations, that is tax liabilities, that is debt repayments. And so there is much more that's going to affect your cash runway than just your EBITDA. So make sure you're looking at the full picture and not just half of the P&L, essentially. Not adjusting fast enough. So one of the hardest things sometimes for founders is changing direction early enough, especially after a raise. So there is often pressure, particularly if you've onboarded VCs onto your board. There's very much a lot of pressure to keep growing, to keep maintaining the momentum, avoid looking negative to investors. So sometimes business can really delay difficult decisions. That might be something like a redundancy or shutting down a whole SKU or pivoting the product somewhat. And sometimes small adjustments early are much less painful rather than major cuts later on. So you do need to survive those difficult periods. And if you're finding that the current status quo is just not working, by persevering, you may not necessarily survive, and you really do need to sometimes make those hard decisions. So again, that's something that you can model, but again, if you don't make those tough decisions, you may have real problems. With really successful startup scale-ups that I've worked for, there were quite a few difficult decisions that had to be made, both from changing the product and doing redundancies, and even cutting new regions. Fortunately, they did survive, but they did have to make those difficult decisions. The next one is finance is brought in too late. So a lot of startups really don't hire experienced finance leadership until problems exist. So that's reporting is messy, forecasts are unreliable, cash visibility is weak, decisions have been made without proper financial support. And this is why fractional CFOs have become quite common in startups. I do have a video where I talk about if you're inheriting a mess because you're the first time finance leader, what do you do about it? So I'll leave a link for that one above and below because it's not an uncommon problem. So coming in as the first finance leader, cash is usually the first thing that you need to look at, just because it's so important for the survival of the business. So strong CFOs, they're always thinking about runway, always scenario planning, reviewing the burn rate, hiring pace, fundraising timing, and also working capital. And they're not just looking at the historical reporting. So make sure that you are thinking about all of those things when you're in your finance leadership role and communicate quite early if you find anything that's not working the way it should be, particularly with your founder, so that you can work together on making real decisions before those problems become critical. So, as I said at the beginning, most startups do not run out of cash because of one terrible decision. They run out because of these key things that I talked about. And in startups, cash really gives you options. So once cash disappears, those options disappear really quickly too. And so then you're just in survival mode. And if you've worked with startups and scale ups like I have for quite some time, working in a startup in survival mode is not very much fun. So this is very much part of a series on startup finance mistakes. So other videos I've done on this is why startup forecasters are often wrong, KPI mistakes that many startups make, and the finance tech stack mistakes as well. So if that sounds interesting to you, then click on the links below for that. If you want to become a CFO in a startup or scale up in the next 12 months, then I've got a 3-step plan for you. The first one is to subscribe to this channel. I do a video every single Thursday as an experienced CFO in the startup scale up world. The second one is to check out my book, Financial Leadership Fundamentals, How to Become a CFO in a Startup or Scale Up. And then finally, you might want to take a look at a course that I run where we have Q&A sections every single month. Otherwise, thanks so much for watching, and I'll see you in next week's video. Cheers.